CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund.
Hello and welcome to CNBC TV 18's Women and Money series presents Financial Quotient powered by For Her, an investment education and awareness initiative by Aditya Birla Sun Life Mutual Fund. I'm Sumera Abdi. Now, in today's day and age, starting investing early is extremely important. But what is critical is also keeping a keen eye on consolidating and reviewing your investments. So let's find out all about how we can align our investments to our financial goals. And for that, we're joined by Mrin Agarwal, who's the founder and director of FinSafe India. Hi, Mrin. Thanks very much for joining in. Getting started, as difficult as it may be, is still relatively easy compared to, keeping on the track which you're meant to be on, right? So first, can we talk about, how do we actually align our investments to our goal? And secondly, how do we make sure that we stay on the right track?
Thank you, Samara, for having me on your show. It's always a pleasure to speak with you. And yes, it is very important to align your investments to your goals. What I normally see is that people tend to invest in a very ad hoc way. They look at investments that are doing well and tend to invest in that without really thinking about how long they can hold these investments or what is the sort of risk that they can take. So, the next time when you are investing any money, the first thing you need to ask yourself is how long can I hold this investment? And secondly, what is the risk that I can take? And for existing investments too, you need to do this exercise to see that, okay, so if I've invested in a particular equity fund or a debt fund also, you need to figure out how long you can hold this and whether the risk that you're taking in it is aligning with your risk. And by doing this, you'll get a better understanding of which investment you can use for which goal, and hence it'll also keep you more sane during volatile times.
And Min, what are the big financial goals that people should be preparing for? Because, a lot of the times when we meet people, they say that, oh, I want to just maximize my wealth creation. Very few of them would have earmarked, X amount for child's education, Z amount for retirement. Mostly it's just this one big corpus. Is that the way to do it? Or should at least the big financial goals have their own kitty, which is running simultaneously?
You're absolutely right, Sumera. Most people do, again, create this big kitty. But I think what's very important is to demarcate your goals, because when you demarcate goals, it becomes easier for you to also keep a track of where you are with respect to those goals. I mean, imagine you're saving an amount of money and saying, okay, I'm just going to use it as and when I need it for my financial goals. Maybe you might not be investing in the right way. So, if you really want to optimize all of this, you will need to have your separate goals, and the main ones of course being retirement, children's education. It could be also about what you want to do later on in your life, so you'll have to figure out your goals and demarcate them and invest accordingly as well.
So, how often should these investments then be reviewed? I mean, for each goal, is it to be reviewed separately, or do you just en masse do it, say, annually or quarterly?
I think an annual review is good. You really don't need to do more than that, because if you do it on quarterly basis, you might end up taking some decisions based on the market volatility. So I think it's best to do it on an annual basis and stick with that. And that could be calendar year or it could be financial year.
Rin, the other thing is that, an optimum number of funds, say, in somebody's portfolio would be eight. Would this be eight per financial goal? Or, I mean, whatever, five, six, eight, whatever number the person decides per goal, or would it be on the whole?
I would say on the whole, because anything more than that is going to be very difficult for the individual to handle.
Okay. So, in terms of asset allocation and especially goal based asset allocation, can you give us the step by step procedure? Where does a person begin? How to differentiate between, asset classes and products, and what is the optimum mix? If you can say, let's take a goal like, say, retirement, how would you align it, a portfolio to that?
I think this is a very important question, Sumera, because A lot of people hear of this term called asset allocation, but they find it that much difficult to figure out what asset allocation they should have. So, the scientific way of doing it is through a goal planning or financial planning, where you list down each of your financial goals. And for each of the goals, you could decide investments based on the risk that you want to take. And you could also have an overall asset allocation for the portfolio. So that's the first level of thing that you will have to do. Again, if you're not able to figure out how much do I take for each allocation, you could think about it this way. Okay, so am I happy with having 30% in equities? Am I happy with having 40%? What is that level beyond which I'm going to get really worried about putting money in equities? And you could also form your asset allocation that way as well. Now, what is a good asset allocation? I think for someone who's conservative, maybe a 30% equity exposure. And I do believe that in order for equities to really make an impact on your overall wealth, you do need 30% minimum exposure. So I would say for a conservative investor, at least 30% equity. And for somebody who's aggressive, certainly it will be 60 to 70% equity. Now, you talked about retirement. And I think that's one of the goals where people should take more risk than what they're willing to take, for the simple reason that they have a very long term to go for retirement. So, certainly, if you have more than 10 years to go for retirement, I would actually say that even if you are a conservative investor, you should look at investing at 70% in equity, because that's what's going to give you the kicker in your returns. So that's what I would do for retirement. I would do 70% equity and I would do 30% debt.
Mrin, in many of the cases, we find that a lot of people have also not earmarked enough by way of funds, right? So, which is the right way to assess that, how much money you'd realistically need to fulfill that goal, and how do you scale up the investment for that over the time period that you're looking at?
Well, there are many goal planning calculators that are available online that you can use to determine how much amount you need to save for a particular goal. As far as scaling up that amount goes, well, you'll have to basically try to save more. You'll have to follow the budgeting rule, which normally I recommend 30, 30, 40, which is 40% savings and 60% expenses. So, I mean, in order to bump up the amount, that's the only thing you can do. But I think the start is really working on a goal planning tool that will tell you how much you need to invest.
What about people who already have, existing portfolios before they decide to sort of follow this goal-based asset allocation? How do they consolidate, their existing investments, a lot of which might also mistakenly include insurance?
Yes, so it's a good time to, in any case, do a review right now since we're at the beginning of the year. Look at the sort of returns you've made. So very simple, you can just do a simple returns calculation on an Excel spreadsheet. You don't need any fancy app or anything for that. Of course, there are various tracking tools that are available online. If you're comfortable giving your data to them, you can do that as well. But otherwise, just on a simple Excel, first of all, work out what is the value of each of your investments. For example, now the investment linked insurance policies, you can find out what is the current surrender value and then do a backward calculation to see what is the sort of returns that you've made. So I think that is the first step. I think all investors should learn something known as XIRR, basically, which is the actual return that you get on any investment. There are lots of YouTube tutorials on XIRR. So, first and foremost, calculate that and then look at the ones which are underperforming. So, when you look at mutual funds, for example, you cannot look at a fund in isolation and determine whether this fund is underperforming or not. You have to look at it relative to the benchmark and relative to the category average to really see if there is sustained underperformance. Now, funds go through various cycles, so there'll be up cycles, there'll be down cycles, and I think you'll have to at least look at 18 months of performance to gauge whether there's underperformance or not. So, typically, this is what you do in a review. It's easier said than done. I mean, and this is the reason why you would need the help of a financial advisor to do it.
Mrin, when we are reviewing the portfolio, say, your equity component has gone up more than what is required, or, any of the assets, I'm just taking equity as an example here. How do you rebalance it? Do you exit the investments which are making money, or do you exit the investments which are in a loss?
That's an interesting question. So first and foremost, there are two things that you can do, uh, and again, do this on a yearly basis. Look at what is the excess in a particular asset class. I would typically say only if it is up by 15% and more. So let's say you started with 30% equity and it's got to 50%, right? So keep that, like, first of all, have this number in mind. What will be that number? Is it going to be, if it crosses 10%, 15%, I would ideally suggest 15%. So if you see that the asset allocation has gone up by plus 15%, that's when you would look at doing a rebalancing. Now, when you are doing rebalancing, you have two options. Either you can do it from the underperforming, or you can do it from the ones that have done really well. I would say do a combination of both, because the point is that you want to exit some of the underperformers. At the same time, you might also want to do some amount of profit booking from the overperformers as well. So do a combination of both is what I would suggest.
And Mrin, closer to goal, what should be the strategy from, in terms of asset allocation? Because you'd have a lot of equity exposure, etc. You'd want to move it to safer instruments. So how should they taper that down?
I always recommend that 1 year before the goal, look at what is the value of your investments. And certainly, if it's close to the goal, then look at paring down the equity exposure, moving it to debt, because you want to basically protect that value. In 2020, when we started 2020, for example, let's say a fund was giving the 5 year SIP return was about 15% in January of 2020. By the time it went to March and May, because of the fall in the markets, that return had come down to almost 1%. And at that point in time, we heard a lot of people cribbing, obviously, that their returns have come down and they need money for their goals. So, this is exactly why a year before your goal, you need to look at paring down your equity exposure so that you can protect that value.
Mrin, thank you very much for joining in to explain this concept of, how people can align their investments to their financial goals. And when you couple it with the fact that, the kind of review and consolidation that's necessary to ensure that, investors remain on the right track, it becomes very, very important. So thanks once again. And for everybody who's watching, I hope there are a lot of takeaways for you as well. So thank you very much for watching. Stay safe.
CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.